Unfortunately, Robbie showed you $2.something billion in savings. Anybody done energy efficiency lighting in here? Did you get the lights for free? No. Did you get the install for free? No. I'm going to be that guy who's going to say, you know what? Whether you believe in solar, nuclear, wind, battery storage, whatever, the bottom line is you're going to have to spend money to save money, right? So what I'm going to try to do today is not tell you, hey, guess what? In New England, I've come up here, and for the third year in a row, I'm going to tell you that you have the highest electric prices in the United States. You guys know. What I'm going to try to do today is tell you kind of what's going on in the marketplace. You know that you have high prices up here in gas. You know that you have solar coming. You're one of the leaders. You are the leader in Massachusetts, I should say. Massachusetts. You're from Massachusetts, the leader in solar. What I'm going to do is try to put some numbers, some thought processes today. Okay, some thought processes today. So basically, we're going to say, I need a bad guy, and I said, I'll go ahead and do it. We're going to talk about natural gas and commodity basis, what is basis. I'll talk about that. Electricity, energy is a good thing, right? Energy is a good thing. We're going to show you some other things that energy is going down, other things are going up. And we'll talk long term about renewables and the T-word transmission, what may be coming down the pipe, pun intended, transmission. So the first thing I wanted to do was to show you a price chart, just so we can refresh ourselves as to what goes on in New England. This is going back to 2014. And the Algonquin, what is that? Algonquin fixed. That is the price of the commodity, typically set by the NYMEX New York Mercantile Exchange, plus a basis number. In the winter up here, the number is an adder. It can be as high as $7 for the February month. It can be as low as negative for the summer, but you get a fixed price. And then that's mass up, dollars per megawatt hour around the clock. What do we see? Gas goes up, what happens to power? Power goes up. Power goes down. Gas goes down, power goes down. All right, so I wanted to just kind of put your attention, but what's happened here recently? Kind of starting to stabilize, right? These wild volatility swings have gotten less. So we are seeing some stability, still pretty wide ranges, but nonetheless, we are seeing some stability, and we're also starting to see power separate just a little bit. All right, we're getting more efficient power plants coming in. We are getting some solar, we are getting some wind, some renewables to start to separate on some peak days. So I want to just bring your attention to what's going on. Big news story, still tied to gas, electric, but it is raining time. Let's switch our focus now. There are two pieces when it comes to natural gas. Whether you're in any part of the United States, there are two pieces of the puzzle. That is the commodity portion of your gas bill, all right, typically set at the New York Mercantile Exchange, and the basis, which is just the differential between this price point and the Henry Hub. There are times when gas up here is plentiful, demand is low, and the price here is lower than Henry Hub, so that basis is actually a negative number. So we take the commodity and we subtract the number. In the winter we add. What do we see here moving up in time though? Now let me put this in perspective for you. Over the last 5 weeks, the price of natural gas has gone down 77 cents, up $1.13, down 44, up 67, and then in 5 trading sessions, 5 trading days, went down 67 cents. So it's been very volatile in the spot contract. But you don't really see that here, right? We have pretty much stability. So what's happening is the market, and this is my opinion, what I think is happening is there's so many changes going on, right? We have Trump hands discussion. We have Robbie talking about battery. We have wind, solar. I think traders, I think somebody comes and says, well, why are you buying or selling it? Why do I think this is going to happen? Really? The regulatory risk is crazy right now, right? So I think what you're seeing here is just an uncertainty, and we're taking the volatility and putting it in things that we can see. So we have the spot contract moving pretty rapidly up and down based on information, weather, whatever it might be. But the back end of the curves is fairly stable as we move out into, and I segregated it for you, summer, winter. So at least at the Henry Hub, down in Louisiana, we're seeing relatively stable prices. We're not above $4, right? So in the past, I mean, just recently we touched $4 briefly, but for the most part, looking further out the curve, we're pretty stable. Now, the takeaway here is as we do this, you're like, well, that's very surprising because aren't things changing down around the Henry Hub? I mean, there's things going on down here. Yes, there are. What's happening? For the first time, what are we? An LNG exporter, Sabine Pass. That's what they call, they go on the trains. They put them like a train car, that's why they're called trains. Each train can consume about 700,000 decatherms of gas a day, right? So what's happening is the trains are getting built. We're taking cargoes. The first few cargoes left went down to South America and to Mexico. Now they're going through the Panama Canal because they're big enough for ships. They want to Asia. And we're shipping LNG out here. These numbers here, you see, are what I think will happen based on already on record amount of gas from Sabine Pass. We're going to increase it in 2017. Mexico, record amount of gas in 2016. We're going to increase it in 17. And industrial demand, the bulk of it is occurring down in the Gulf of Mexico. So it's interesting that these are very stable, yet we see these demand increases coming. So the question you asked is, well, there's going to be a lot more production. What might be happening here? We're going to try to put the pieces of the puzzle together, talk a little bit what might be keeping these prices stable despite some of these significant demand changes around the globe. So let's move our attention now. This is the NYMEX and the calendar. I just took the NYMEX prices every calendar year, added them up, divided by 12. Right? But the first line up here, the off line, back in December, we trade futures. So today's January, the first futures contract is February. But back in December, that was the calendar 17 trade. It was January to December, added up, divided by 12. Again, you can see the spot calendar year very volatile, right? That off line moving up and down. The second line, red line, is Cal 18, not quite as volatile. And then the other ones, pretty much sitting at the same price. Right? So something is going on here, right? Something's going on. I showed you demand and even the calendar strip. Something's going on. Well, one of the things that's going on is the CFTC is the overseer of futures exchanges like the SEC is to equities, Pawnee Futures Trading Commission. They put out a report every week and they let us know what's kind of going on by sector. So if this half of the room wasn't a potential consumer of commodity, you would be called non-commercial. I mean, excuse me, commercial. Now here, if you only trade paper, you couldn't take delivery, just through a paper trade, you'd be non-commercial. They break it down even further, and they say, hey, here's producers, merchants, and users. It's kind of oxymoronic because you've got a producer that wants to sell high and lock in a margin, and you've got an end user who wants to buy low. And here is managed money. This is the pure, what we call speculators, smart money, and there's their positions. For every futures contract, for every long, there's a short. Cannot equities by incorporating and incorporate and say, I'm going to have 50,000 shares and I'll be it until the next time I do something. But with equities, you buy, I sell you one, and then I sell you one, and I sell you one. There's 3 contracts. So I sold all 3 of them, but you bought 3 individual ones. So the bottom line is that position here is short. Okay, short. Producers have been selling. They like the price that they see. That volatility has been good, so they're selling and locking in a margin. At the same time, managed money starting to see some of these changes going on at the Henry Hub rate. We're starting to see LG's leaving, Mexico's leaving. So they've created, not entirely by themselves, but weather stuff, but they've created some volatility in the front. And this is a record net long position. But it's almost like, remember Rock'em Sock'em Robots, the two smashing each other, right? And they would just be like this, and then you had to go up and put it back down. It's kind of like every time this group's been buying, this group's been selling the producers. So it really has helped to keep prices down. That selling has helped to limit maybe some of the spikes that we've seen. In addition to that, it signals to the market that there may be future production. So when I asked you, is there going to be future production coming? Why are we so flat in the back end? Possibly the market is interpreting this as a future production. So I'm going to give you an opinion. It's not a direct energy opinion. It's not a centric opinion. Here's the opinion. When we were looking at Marcellus 5 years ago, if I was standing up here, we had, I'll just make a number, 100 producers. Right? Now we have 50 because of low gas prices. And the 50 that are left, maybe 20 of them are really astute. And shareholders say, you know what, I like the returns you're giving me. These low prices are killing me though. They're killing you, and my returns are starting to slip. You maybe should, every time you get the opportunity, hedge. So this is kind of something the market's going to watch. It's going to maybe interpreting that we're going to see a lot of gas in the future. And that includes Marcellus. This could be Marcellus and Utica. We work with a lot of producers in Marcellus and Utica, direct energy, and I can tell you that they have been part of this whole selling thing. The point here is, I've got managed money staying in the marketplace. They may be added to the volatility. I've got producers out here kind of offsetting some of that. Maybe signaling to the market that future production is going to come, and that's why we see a lower end price in the back with flat. All right. Let's switch now. We're going to bring it up to this area. This is Algonquin. This is a pipeline that comes into this area. And as you can see here in blue, and as I mentioned, in the summertime it can be negative, right? And in the wintertime it can be positive. Add up the commodity NYMEX that I just showed you, and those seasonal things, and that's what we get. Again, what do we have? We have summertime prices that are pretty good. So if you were a manufacturer, what would you want to do? If you could, you would try to move as much to the off-peak periods of demand for gas as you could, right? Just like electricity. And again, it's flat. Kind of interesting, isn't it? It's flat. Really similar, very similar, the basis end. So again, I think a combination of thinking that production might be here, thinking that I'm only going to trade what I can see. There's no reason for me to trade out the back. And the reason I bring that up, let's look at just this 1 month of February, okay, that's traded. The basis market in February, just 1 month, traded down to $3.50 a day. Just the basis, not the money. Traded up to over $7 and back down to $5. Right. So if you're a trading manager, you go, what are we doing here? This is a lot of money. So I think we're going to see probably some liquidity out the back of the curve is a little lower, but there might be something else that's going on. All right? Now, getting back to my example, I'm not going to spend a lot of time with drilling and all this stuff. This report is out every month. What do we see in Marcellus? Despite me telling you that I have all that hedging coming, what do we see in Marcellus top right? Production has been flatlining, correct? So this kind of is what I'm telling you. I used to have 100 producers, now I have 50 producers. The most astute producers are still producing, but you know what? Are they going to be able to move the needle? Is production going to go up? Same with Utica. Utica is very oil driven, all right? So we're going to keep you posted on this, but again, I'm kind of concerned that the market is taking a little bit more bearish view than I think maybe they should take as it relates to production, because I'm taking every pipeline in America. Oh, sorry about that. I'm taking every pipeline in America, and what am I going with it? I'm going to the mid-continent. I'm going down to the Gulf of Mexico. I'm going into the mid-Atlantic. The Access Northeast, if you weren't aware of it, EDCs up here, electric distribution companies, EverSource part of that, came into Spectrum and wanted to buy capacity, gas capacity to utilize in winter, and then sell it off, and it was shot down by Massachusetts and some of the other states. It's being brought back in court into Rhode Island. I don't know what that's going to solve. I'm going to say that Access Northeast, my opinion, is probably a long shot, and the Atlantic Bridge is another project, but the Atlantic Bridge is more of a project that ties into Maritime's Northeast pipeline that goes up into Canada, and so we have to have things change there. I'm not saying that these aren't going to happen, but for this area, the bulk of the capacity has occurred. The aim is Algonquin Incremental Market Project. It was 342,000 decatherms of gas that's come up here. The good news is, on the coldest days this year, gas prices didn't go to $12 like they did before rain. They only went to 8. Okay? 8. It's still a very high price. So, what's the impact of AIM, Tim? I'm going to say about $4. All right? Still good. It's good news, but the bottom line is still $8. The point here is in this area. Gas is, even if that Marcellus, even if that Marcellus and Utica starts to go up, pipelines looking to take it away from this area. So those numbers I showed you, those dry numbers, maybe stay flat. They might not go down as much as people think because the gas is leaving. So if somebody says, well, Tim told me Marcellus Utica production is going up, yeah. But he also told me pipelines are taking it away, yeah. Also, that's maybe why my gas basis isn't going down. That's why my fixed price might not be going down. So let's move to electricity. All right. So I wanted to now show you some squiggly lines. I want to show you specific months, specific examples. So what we have here is the NEMA zone, right? Well, these are master zone, and there's that February. Okay, so I broke out. Let's just look at February. Look at the range on February. All right, just for peak prices, we have $50 up to $160. The black bar is where it was when I did it the other day, and this is the range from when I did it the other day to 2012. All right, so what do we see? We see continued volatility in the winter peak months because we have gas volatility. But the bottom line is the black lines are starting to drop lower and lower and lower in some of these off-peak or lower demand months. So it is a good news story. It is a good news story. What's happening is, what are we doing? We're taking cars that used to get 20 miles to the gallon, we're replacing with cars now that get 40 miles to the gallon, right? I.e., we're taking a power plant that used to take 10, 12,000 BTUs to make 1 kilowatt hour, and now they're doing it with 7,000 to 8,000, right? So they're running less, so more efficiency. So even at higher gas prices, to give you an example, if I have a 10,000 heat rate power plant and I put $3 gas into it, I get $30 theoretical power out. 30, $3 in, 30. If I have a 7,000 heat rate power plant, which is being built, footprint, going to be in Salem, right? 7,000, 3 times 7 is 21. It's a $9 difference, the same gas price, right? So it is a good news story as it relates up here to electricity. Black customers, and this is where I'm going to be the guy. He said, you're going to have to be the guy. I said, okay, I'll be the guy at the party. And you're like, what's this? You get your bill and you say, Tim, see my energy price is going down. Wow. But my total bill is not going down. Why? Because the other charges in the market are capacity and ancillaries. Okay, what is capacity? So, you know, when Ron showed that slide, it's called a duck curve. You have a little ramp in the morning, and it goes down midday, solar, wind, whatever. California's a classic example of that. And then a big ramp up in the evening, okay? And that midday, that's when Calpine Energy, Exelon, other companies with generation, Dynegy, that's when they're making their money, right? But right now, what's happening is, with all the wind and solar that's around the country that's being put in, including up here, we're having generators who need total dollars, and they're not getting it from the energy market, so they have to get the missing money somewhere else, and they get it from the capacity market. So in the capacity auction, generators are saying, you know what? I'm not making enough in the energy, so I have to adjust for it in the capacity market. So capacity is basically the option value we all pay as load to have a generator there when ISO New England calls it, right? Ancillaries are just other things, black starts, there's just things that go in there. If a unit goes down, I need a unit to be paid money. So, well, I can sit around and wait, potentially be turned on a hot day in the summer, but it's going to cost money. Point being is, these numbers here have not changed significantly, despite energy costs going down. Your total bill, if you were to average these, hasn't really changed a whole lot. All right, so that's the takeaway here, that there is a good news story. As I said to you, when you change lights, you know, you're going to put lights in, it's going to cost you something to put them in, but you're going to save money down the road. The good news is we do have energy decline. The unfortunate thing is some of the other charges are not, and your overall bill is not changing dramatically. Here's just a visual of what I just said. To give you a sense per kilowatt hour specific of some of the zones in here, you can see that it did go up. It's come back down again because we have more efficient plants. We have those efficient plants want to get paid. The problem here is, if you're not aware of this, there was PJM and New England had issues in the vortex for winter, right? Where units that were getting paid capacity dollars did not run. But by the tariff, they can still get paid capacity dollars. People said that's not fair, that's not right. So what they did was they created a winter reliability program. They brought in some oil, brought in some LNG, energy efficiency, demand response, and said, you know, for the next, we got one more winter, 17, 18. We're going to pay money for that, right? I'll show you a slide in a second. And then the other generators, we're gradually transitioning to, if this room runs and this side of the room doesn't, you all pay this side of the room, right? It's going to keep everybody on. So here's my point. I should have duck curve. I'm not making energy prices now. I got a lot of solar and wind, but they still need me. The problem here is all these numbers are going to start skyrocketing again. All right, that's why I'm going to be the bad guy here. Are these numbers going to start going back up again because of the changes that are coming in? Because ISO New England, I certainly like PJM, ERCOT. State of Texas the other day produced a record amount of wind over 15,000 megawatts. That period was 46% of all generation. So all those fossil fuel plants were turned off. They were like, I can't live like this. I need more money. So takeaway here is these prices might start coming back up again. Here's the winter reliability program. I'm not going to spend it. This is on their website. I just want to show you the numbers, right? Everything costs money. Again, I'll be in the back. Okay, everything costs money. If you want to have reliability, it costs money. All right. So my esteemed colleague said, Tim, I don't understand this slide at all. This doesn't make sense to me. What are you talking about? I said, it's for me to know, you to find out. Give me $5. Anyway, all right. So, qualified Massachusetts, qualified units, a REC, 1 megawatt hour, right? If a unit gets qualified, more than likely it is going to produce what it's going to produce, solar, and a REC is going to be issued and it's going to cost money. And who's going to buy all of those? We are. Here's the percentages going up. Okay, qualified going up. Not only is qualified going up, because they're going up, they're going to be out there in the marketplace, and the percentage of how much load-serving entities like Direct Energy or any other entity has to buy is going to be going up also. Now, if the price of that renewable energy credit goes down or stays the same, and my percentage goes up, if it goes down and I say we just increased by 2%, what would the price have to do for us to stay the same on our bill? It would have to decrease by 2%, correct? It's not. So the point here is that, yes, we're getting solar. It is going to cost you something. And again, you're going to see energy maybe stable going down, but you might see capacity going up. You might see your solar price, your solar bill. I think up here in Massachusetts, what, 25% approximately? When I looked at the last bill, about 25% goes to renewables, Mass, I think. So just something to bring up, again, here's projected growth, okay? I am not making a case for or against solar. I'm just letting you know that I can put dollar signs to every one of these bars. And the dollar sign will be bigger and bigger and bigger probably, right? In some cases. It'll stabilize. But you can see Massachusetts takes the lead in New England. All right, let's switch over real quick to renewables. This is from ISO New England. I just grabbed it. If you go to the ISO New England website, I'll tell you if you're really interested in what goes on electric markets, they're probably the best, in my opinion. PJM site, but they're probably the best for keeping their clientele informed. They have 3 papers now that they just printed on the front. PDFs are really great. It keeps you up to date, tells you what's going on. This is one of the programs, papers they put out. And what do you see here? We see growth, energy efficiency. Even if I took this away, energy efficiency, we still have growth. right? We still have growth in that. And unfortunately, you know, state policy as well as federal tax support. Yeah, what if federal tax support goes away? I can tell you this, reading a lot of the investors and some of the big wind people are like, you know what, PTC can go away, we're good. They can compete now. Same with solar. So as I said with you, those bars, where the cost might be going up in solar, you might start stabilizing because everything I read now from the people who are building the units, the PVs, and the wind, is that they've been able to get the cost down to enough. Rhode Island, right, 30 megawatts just came online. If you haven't seen that plant, I don't know if you have ever had the opportunity to get out and see it. The blades in that plant, I think, are almost double the size of the standard blades. Some of it's an enormous facility. It's only 30 megawatts, but the blades are enormous. But yeah, I digress. The point here is you may see some stability coming in the future. So I wouldn't be quite as scared if I see the production tax credit, the investment tax credit for solar go away, because everything I read, the engineering is starting to take hold. Lastly, this is now direct energy. We have a group over here, and I'm going to call them our customer. I like to call themselves. They're our customer support group. Why? Because if you have questions, we're here to answer these questions. We have a regulatory group that keeps us informed. This came from our regulatory group. Nice summary. Mark Hanks is the gentleman who put this together for us. Basically, the Mass DP Clean Energy Standard. Okay. If you're not aware of the Clean Energy Standard, how many people have facilities in New York or are familiar with New York's energy market, New York's market? Anybody? What did they just do recently? Zero emission credits under the Clean Energy Standard. They're going to keep 3 power plants, not any point, but they're going to close that. They're going to keep 3 power plants open to the tune of about $450 million, and the whole state's going to pay for it. The whole state's going to pay for it. They're going to issue zero emission credits. My CERT is going to do it. So California's Clean Energy Standard, New York ISO, and Massachusetts. These are what's proposed. These are what's proposed. You can see these are big numbers, right? These are big numbers. So I'm here to make you aware of some of the things going on. I'm here to have you think about, when you look at your bill, your budgets, what are you doing, what might be the, maybe you want to do a low, medium, and high case. Maybe you want to get with whoever, us, whoever, to sit down and maybe try to put some numbers. But these are some of the things that we see coming in Massachusetts. I do not see a significant amount of pipeline expansions occurring up here. I do see that we have that ductor. We're going to have more solar, we're going to have more wind. It's going to lower the peak shade, right? It's going to lower the peak shade, but that might impact who? Generators. Generators might do what? They might increase their capacity costs because they're missing dollars. So we have a lot of moving parts. I'm not going to say it's complicated. Raising a 2-year-old is complicated. This is just a lot of moving parts. All right, lastly, when the pipeline was getting built, Northeast Energy Direct Net, guy came up to me afterwards and he said, let me get this right. You want us to spend $1.2 billion to bring a pipe up here. Well, even under ISO New England's worst case, 10 days. And you want to pay us $1.2 million for a 10-day peaking service up here for gas? This doesn't make any sense to us. Lo and behold, nobody signed up for Northeast Energy Direct, and that pipeline was canceled. These projects on here have been proposed. This project just got announced, TDI Northeast, 1,000 megawatts, has a production permit. I didn't really realize I had not spent enough time with understanding what a presidential permit is, but it needs authority to get it over the border. It's been approved. Will it come in? It's moving pretty rapidly down the pace. And there are entities who are saying it's cheaper to do this than it is to build gas pipelines, to hold the capacity costs of fossil fuels don't go up, right? So there's a lot of competing things going on. This is going to be another one of the competing things that's happening. The pipeline issues up here might be, I'm not going to say tabled, I'm not going to say dead. The new issue probably up here is going to be, do they get built and who pays? Now in the Christmas story, what did Dad say to Ralphie? Did you tell Santa Claus what you want? He said, no. He said, but don't worry, Santa Claus knows, he always knows. So I take that and I say, low pays, lower always pays. All right, and I'm not trying to flip, it's just, again, I wanted to come up here, make you think about some of the things going on. You have budgets, these are some of the issues that are going to be on the table, and there are going to be costs associated with them, and unfortunately, costs always get pushed to the low. All right, so with that, I'll stop and ask if there's any questions. Yes.
So I guess my first question is, we have to figure out what you just said and how that is
Think rock and roll.
I imagine that, when Mr. Trump becomes president and changes all of this and starts exporting all of our LNG or takes a lot of our tax credits away, this could change?
You know, I think if anybody says that they have any idea what Donald Trump's going to do, I've got a Ouija board out in the park. We can all go out there and we'll just use the Ouija board. Come up with something. Will it change? Here's all I'm going to say. He's a businessman. Money talks, and you know, bad ideas walk. And I think it's a good idea, and it saves money. That's my opinion. And I don't know what Donald Trump's going to do, but my opinion is he's not going to turn back the tide of certain things. You know, that's just my opinion.
Right.
You know, I think there's so many jobs involved. So the next thing we didn't discuss, I mean, in coal country, there's been a lot of proposals in coal country say, hey, listen, so we're not producing much coal. Why don't we retrain these people? Let them build wind power, let them install solar, right? So there's again some incentives to say this is not always a bad thing. Yes, load is paying for solar, but we are providing jobs and other things. So you know, how it's going to play a hybrid, I don't know. I apologize.
Yes. Could you just slide your microphone
Up.
in the back? And sometimes it's hard to hear you, so I think.
Wow, that's a rare
It's
case.
the acoustics in the room.
Sometimes it's hard to hear me. All right. How's that? Yes, sir.
Yeah, the last 2 years, I've been noticing storage is higher than it's ever been, as far as when they're storing fuels, you know, between natural gas and oils. And I know it's part of it's an offset of what happened 3 years ago with weather. But at the same time, it's kind of scary when they keep talking about capacity issues. Yet we've increased our storage, we're at that limit. We've been down 2 years now in a row. We've had the highest levels of storage we've ever had. So that's got to be affecting the market.
I think again, it's acting as an anchor. It's acting as an anchor. The thing that's happening is now the Henry Hub is now starting to become a very large around here. It's becoming a very large demand center, as I mentioned, right? Industrial LNG. So, and you have storage down there that can cycle in and out, but it's just this continuous demand. I mean, this year already, year over year, we have demand that's already from 2016 the same time period. Demand's already higher, so I'm already shooting up more gas down that area. So I think what's happening is that storage is being looked at probably as its shock absorber value. That's probably one, right? Its shock absorber value is probably one. Where saying, if we got down to 1,500 BCF, or if we get down to 1,000, not a big deal. It's possible the market is shock absorber. I will tell you this: managed money though, and I showed you that. Joe Morris, Trader of Commodity Service Desk, we both know this a long time. When they get in it, they got in $145 group, they loved it. They had $13.70 gas, they loved it. 8 months later, what was it? It was $32 and $2.50. When they love it, they love it. And at the same time, the reason I bring the story, at the same time, it was Tim, storage is setting a record. What's happening? I said, I can't tell you. Production is setting a record. What's happening? I can't tell you. I can just tell you that when speculators get in, sometimes, you just have to throw the fundamentals out of the way. They will equalize. As I mentioned, 8 months later, all that came off. But right now, they may be just putting a little bit more of a shock absorber on storage than in the past. Yes.
Can you go back to the slide that has the capacities? One of them was a red pointed. I'm going back. Right there. Okay. 2017, 2018. NEMO, which is the Boston area. That says 4.51 cents per kilowatt hour.
Once at 50% load factor. Yeah, it's just kind of theoretical.
Okay, so if you're a customer with a 50% load factor, supermarket or whatever, that means every kilowatt hour that you get charged from the supplier, whether it's you or any other suppliers or from Eversource, has 4.51 cents in it just like that's it.
NEMA had they lost a lot of generation, and they had restrictions getting into the area. A lot of that has been resolved. Hence, if you look at 19, NEMA back in. They did shift the zones somewhat, a little bit, but specifically in that period was the worst. That was the most critical time. They lost gen, and they had constraints getting here, and a lot of that's been fixed. But unfortunately, those are the numbers.
That's like half the bill for generation. You're paying 9 cents, right?
Well, that is a big reason why. You know, if you look here, these numbers haven't gone down.
Shouldn't those gray area bars be equal to the wholesale value?
Well, I mean, you're looking at the annual wholesale. This is the annual number, right?
Well, flip back to that other slide. I get my bill from Direct Energy, like 2017, 2018, and let's say I fix the price of you for 9 cents. Half of that's what that's.
For that planning year, yes. So what can you do? You can work with Direct Energy, anybody else?
I cap the worst out.
And what works out, so you can work to lower that through usage, lower that, I mean, that's the multiplier. It's now, your existing customers make the multiplier not 10 units, 8 units, right?
I'm just bringing that to the attention of anybody in the room here. That's insane. Half your bill is what you do in 1 hour.
It's unfortunate.
That's insane.
That's why load reduction is so valuable.
Yeah,
So I
exactly.
wanted to point that out there, right? Half your bill is because what you did for 1 hour. Half your bill all year.
So next summer is,
Yes,
next summer is what's gonna
What
push
you,
you.
well, great, basically what you do this summer. That will set your cap for next summer. Yeah, so what you do this summer, yes.
But if you look down the road, that's gonna change, so whatever you do, it doesn't look like you should invest a lot in doing something that you need for the long term.
If you're looking at it from the vantage point of only capacity, you know, when you say invest, what do you mean by that? I'm sorry.
Well, I'm just thinking, is this a reason to go out and invest a lot in a technology that would specifically, that would be, the economics would be based on that peak?
No, it's peaks have already climbed.
Right.
Peaks have already climbed. My fear is that as we create these duck curves in these states with high wind and high solar penetration in the most expensive, historically the most expensive areas, it is starting to go back up.
Nice.
Just because, I look at this as an option value. All right, I look at this as an option value, and that option value might be going back up. If power plants are like, I need dollars, that's just what it is. Because ISO can't make anybody run, it can't make a unit run. They can issue a reliability must run, and you still don't have to run. ISO cannot force a unit to run, unfortunately. Yes, sir, your question?
Right behind you.
Question for you on there's a lot of.
This is so, they're going to turn this off. Okay?
Yeah, this why I think it's interesting is that with Trump coming in, all these areas that were sort of out of bounds, like offshore drilling and public lands, now the doors are opening for those that capacity, and the gas market is already the drillers are dropping back, and the economy in North Dakota and all these other places, they have way too much capacity out there. So has the market accounted for what is going to happen when we open up all these new resources that we aren't touching right now? And then the other aspect of, it sounds like Trump has wanted to export the heck out of gas to Europe or beat out the Russians and things like that. So how is that factoring into what the future price of natural gas is going to be? It sounds like it's going to stay low for a long time.
Well, the back end of the market, right? Let's look at those strips I had for 2019, 19, 20, 21, what were they? They were all 290. They were all the same price for gas. Now, granted, that's at the Henry Hub, but even when I showed you the basis numbers up there, they pretty much were all the same. So to answer your question, what does the market think? It thinks exactly that. They're seeing gas prices go back up, they're seeing oil prices go back up, and I didn't put a chart up because I don't want to bore you with yet another rig count chart, but rig counts are going back up. Okay? I have that yellow line, hedging is going back up. So I think the market is saying, yes, there is going to be, a continued stability or gains in oil and gas production out in the future, and hence we have a price curve for the NYMEX specifically for natural gas that is what we call backwardated. Higher prices here, lower prices in the future, right? So I think the market is taking that into account. They're also taking into account renewables impact, right? They're taking into account battery storage, taking into account wind. As I mentioned, ERCOT, the state of Texas, on that day was 38,000 megawatts was their peak. Their summer average over 70,000 megawatts. Over 15 of that was coming from wind. The state of Texas is going to build by the end of this year 21,000 megawatts of wind. By the end of this year, they're going to increase their solar PV by 2,000 megawatts. 2,000 megawatts, that's two 1,000 megawatt nuclear power plants. So I think there's a combination of a lot of things going on here. But I think that the biggest thing about leaving with any visual other than rock, stock, and robots is there's two trains coming out of traffic. One is fossil fuels and the other one's renewables. And it's going to be a crash. Yes, sir.
How much of that wind and solar production in Texas is, let's say, market-driven versus regulatory climate-driven?
They are, first off, from an energy perspective, they are price takers. They'll take whatever the price is, they will, recently, it's been a negative, I showed my colleague the other day, he saw negative 13, negative 8, negative 20, because they get the PTC, right? They get the PTC. So when the PTC goes away, the question now will be, will they still have generators connected? Now, there are generators, starting to read articles, especially in New England, that are talking about getting into the capacity market if they're renewable. It's gonna have to transition to that way once the PTC goes away and the investment tax credit for ITC goes away for solar. It will just be that way. But solar will probably just always be what it is, and that is either you're gonna put a battery on it or you're gonna be a price taker. Wind may have some choices to that. Does that answer your question? Yeah. Okay. Any other questions? Yes.
Do you think there is an emotional floor to natural gas prices?
An emotional floor. No. It was just $1.61. Joe, March of this past year? Yeah. March of this past year, $1.61. It just recently traded as high as $4. So, now, is there an emotional floor? No, there's never an emotional floor. It was $145 crude, it was 32, it was $13.70, it was $2.50. But one of the things I did bring up on that slide, those 290s that I talked about, 19, 20, 21, they haven't been below 280 now since October, all right? So there seems to be not so much an emotional floor, but maybe a psychological floor driven by everything we just talked about: storage, production, wind, solar, demand leaving Mexico. So there seems to be a psychological floor out there, and that number seems to be 280 right now. As we go out the curve at the Henry level, and we stand. Okay, good. All right.